Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us is Ryan McCormack, factor and core equity strategist over at Invesco for a weekly performance update in the QQQ. We'll also take a look at employment data and what that could potentially mean as we look towards the next Fed meeting in February. Ryan, it's great to see you as always. Happy New Year, and I think it's a great way to start the year with the Nasdaq 100 and the Qs having a positive week.
Yeah, a good start to 2023. Happy New Year. And we saw QQQ and QQQM up 3.17 and 3.18% respectively over the past 5 days. That outperformed the S&P 500 up 2.53%, but slightly underperformed S&P 500 value of 3.22%. And I think it's interesting and worthwhile to note that we did see some changes in S&P 500 value and growth. And when you look at the methodology, it looks to break up the S&P 500 into a distinct pure value, pure growth, and then sort of a blend category, each with an equal market capitalization. And what we saw in the December reconstitution was some of the larger names that we would generally associate with growth being represented in both S&P 500 value and S&P 500 growth. So names like Microsoft, which happens to now be the largest holding in S&P 500 value and the second largest holding in S&P 500 growth. Or Amazon.com, which is the third largest holding in S&P 500 value and eighth largest in growth. So, generally you'll see some level of overlap between the two, and I think it suggests that some of these Qs heavyweights, at least relative to other names in the S&P 500, have some level of growth and value characteristics.
Let's take a look at some of the employment data. I believe you have either wages or hours up here because, of course, we get the CPI print tomorrow, right? All eyes are going to be focused on that. And then what comes out of what we're seeing in employment reports, what we're seeing in CPI data is clearly going to impact the Fed rate hike decision that we get in February.
100%, and then subsequently we'll have an impact on what we see from a market action perspective. And I mean, this is a pretty good real world example of where maybe market psyche is. So, we kind of started the year under some pressure on Thursday, the 5th. So last Thursday, QQQ was down over 1.5%. And Thursday brought ADP employment change for December, showed 235,000 jobs added for the month, well above the 150,000 projected. Additionally, that day, we saw initial jobless claims dip down to 204,000, so considerably lower than the estimate. Friday, however, we saw a big reversal in the market, and QQQ ended higher by over 2.75%. On Friday morning, despite a larger than anticipated non-farm payrolls report for December, 223,000 versus 205,000 estimate, and the unemployment rate ticking lower by 0.2%, down to 3.5%, wage growth was slower than expected. So year-over-year growth came in at 4.6%, slower than the 5% estimate, and month-over-month came in at 0.3%, better than or slower than the 0.4% estimate. Additionally, year-over-year data and as well as month-over-month data for November, both revised lower. So effectively, I think what we're seeing thus far in 2023 is kind of where we ended in 2022, where we remain fixated on the Fed and inflation. And specifically after the more hawkish commentary around the December Fed meeting, where Chairman Powell was talking about the hot labor market and subsequent upward pressure that wages can put on inflation, in that case, he referenced services specifically. In this case, despite the employment picture still looking robust, right, decent job gains, low initial jobless claims, the slower than anticipated wage growth, I think, helped provide a little bit of optimism for the market and the potential that the economy can hang in there at the same time while inflation may be on the way to getting tamed. As you referenced, tomorrow is sort of the big release, right? We see December CPI. Projections are calling for 6.5% year over year. It would mark the first six handle that we've seen in the reading since November 2021. And the month over month figure is actually expected to decrease by 0.1%, which would represent the first decrease month over month since May 2020.
Right. And Ryan, if we take a look at the sectors that led the way in terms of performance, a couple questions for you here. Is it a sector that was discernible, or was it because the heavyweights that have so much influence on the index performed well?
So a little bit of both, actually. I think when you take a step back and look broadly, all sectors in QQQ were in positive territory for the week, and all but one was positive for the S&P 500. So this would be sort of the single sector example that we could point to. Right, the one sector in the red was healthcare, and healthcare was the largest contributor to QQQ's relative outperformance versus the S&P 500. In QQQ, the sector was up over 2.5%. It was negative in the S&P 500. So they're sort of the sector. Beyond that, the next largest contributor was consumer discretionary. Right, so sector outperformed by over a percentage point in QQQ versus S&P 500. That was largely driven by Tesla, which was up nearly 10% for the week.
Yeah, interesting to see just how much these heavyweights influence the index. Appreciate the insight as always, Ryan. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.